Hello and welcome. This is Be the Bank, the very best place on the internet to learn about the secondary mortgage market. My name is Robert Hythe, your host, founder of FIXnotes, and I'm happy to bring you all of the latest industry content to help you prepare in today's episode for 2022, what to expect and how to get started in this lucrative business. So let's jump right in to today's call. All right, guys, it's episode number 40 on December 29th. To close out the year of 2021, we're going to start with the note investing in 2022 overview. We're going to talk about how to invest in mortgage notes in this new year. Then we're going to talk tech, what you need as a laptop and a phone business to operate from anywhere in the world. And on also, of course, asset acquisition opportunities, case studies, and then giveaways to get you started off right in this business. So let's jump right into it with note investing in 2022, what to expect. So we want to start, of course, with the macro environment. We want to understand exactly what's going on in this business so that you can understand how to position yourself successfully. If you're watching this as a replay, of course, you can use the scrubber bar in the bottom video playback to jump ahead to any different chapter titles throughout the course of this video. If you're watching live, of course, ask me a comment, a question, and I'd be happy to answer on the fly here as we go through the content. So let's start with the macro landscape, and this link is gonna jump us right over to investing in mortgage notes in 2022, the market forecast. So I'm gonna make this a little larger so we can see in more detail. Over at FIXnotes.com, you can mouse over Learn Notes and then click the blog to get all of the articles that we're upcoming. We're gonna post a whole bunch of articles in 2022. So if you prefer to get your information through reading, there's also a lot of videos linked to these articles. You can do so over on the blog. So let's go through this just to understand what to expect in 2022. So note investing in 2021 has been fairly difficult due to supply constraints. There haven't been a number of mortgage note opportunities out there this year due to kicking the can down the road at the highest levels. And we've seen banks through the CARES Act find ways around reporting their distressed debt portfolios. So as you know, as a note investor in this space, or as you will come to know, everything really depends on the higher levels trickling down the institutional product to the secondary market. Now, there are privately originated mortgage notes, but not in the volume that note investors expect. So the institutionally originated loans go through a process of default and then charge off and then sale to the secondary market. But due to these two temporary financial reporting reliefs, banks were able to suspend accounting. This is called the TDR and the CECL relief. TDR is troubled debt relief, and CECL is credit, it's right here, current expected credit losses. So these extensions are actually going to take place until the end of this current year, 2021. And unless there's another extension into 2022, we should see these financial reporting reliefs expire, which would mean that banks need to start reporting their bad debt, which means that most of these banks that have distressed portfolios of quote unquote bad debt are going to start selling these loans to make some space in their balance sheets for new originations and the accounts, the debt accounts that actually are making the money and are performing. So this is the non-performing mortgage note supply issues that we've seen in 2021, hopefully resolved going into 2022. So there's some other links here about, this one is to a YouTube video from Bill by Mel. He had an excellent conversation with Jorge Newberry about the value of these loans, which has been astronomical in 2021, and hopefully pricing will start to come down in 2022. So note investors can buy non-performing loans for more reasonable prices. Here's another concern. The top is probably in for single-family residential home values. We've seen very, very strong pricing growth in residential property throughout the country this year in 2021. But I think maybe we've seen that peak, and in 2022, pricing maybe will come down. Now, I don't have a crystal ball, so I can't tell you with any actual certainty, but I can tell you that I do believe that we're going to see lower home values. Now, this is a double-edged sword for note investors. On one hand, if you already own loans, you're going to see less equity as property values potentially stabilize, which would mean the equity remains the same, but they could also go down, eliminating some of the equity that we see as note investors. But for note investors who are active in the space and are looking to acquire new mortgage notes, this is a good thing because this means that pricing on this side of the business is also going to be reduced. Now, at the end of the day, you make your money when you buy mortgage notes, so you're going to be pricing this in as a moving target. As property values change, you can adjust your expectations as a buyer. Now, finally, we do have some links to the latest housing market data and statistics, and the conclusion here that I've drawn is that there's more inventory on the way. As these charged off portfolios are released by the big banks due to the accounting reliefs expiring, I think we're going to see more product, more single family residential secured non-performing mortgage notes hitting the market, which hopefully will decrease the pricing that note investors are expecting to pay for non-performing loans and increase the amount of opportunities that are out there for you. So this is a great thing for note investors. It's going to allow us as real estate note investors to help support this market of non-performing loans. Right now, with the kicking the can down the road, you might think it's a good thing for borrowers because they don't have to pay, but in reality, their balance is owed, their forbearance agreements sometimes, or potentially just being in default and being charged off and not knowing where to make your payments cause undue stress on borrowers who eventually do have to address these mortgage loans. So note investors are able to solve this logjam for the big banks and help these borrowers come to new payment terms on their loans or gracefully exit their properties through short sales, deed in lieu of foreclosure, or worst case scenario through the foreclosure process. So I believe that eliminating these accounting reliefs is going to allow note investors to support a healthy real estate market. So that's the main thing, the first thing we're talking about here, the macro environment. And the idea is that pricing will come down and there'll be more product available for note investors going forward. That's the goal here. So next step, how to start the business. So this is also a hyperlink over to the blog. We have a really excellent article, one of our best, called How to Start a Note Business with No Money. So this is an awesome article because it explains how to do this business, getting into the space, learning the skills that you need to really take your career to the next level while actually not having the capital to invest in mortgage notes directly. So I'm not going to go through this entire article, but there's a lot of links to different, here's one, to different episodes of this show that explain different things that you need to understand, skills you need to learn, and abilities you can master to set yourself up to eventually buy your own loans, but making money and earning and learning in the meantime. So definitely encourage you to check out this article and leave a comment if you have any questions at all. We'd be happy to answer them here or on the YouTube video if you'd like to leave a comment there. So since I'm not getting into that specific article in extreme detail, we're going to go take a step back and understand if you do have capital to invest, or maybe you've already went through that earn and learn process and you're ready to buy your first loans, a couple of different ways that you can do so. So in note investing, there's a lot of opportunities from passive to active that you can get started. Now on the passive side, you're going to see lower returns, of course. Investing in something like a mortgage note fund gives you the opportunity to put the funds out to an experienced operator, a counterparty that can own the loans and manage the loans for you. And then going all the way through to the active side of buying and working out non-performing loans yourself, you're going to see much higher returns, but obviously you're going to be putting in a lot more work. So just as a rule of thumb here, and maybe it's not entirely accurate based on your skill level, there's a lot of upfront work that you need to do to really master this business to get started. But I think if you've got less than 10, 20 minutes a week, perhaps once you just set and forget it, less than that, a mortgage note fund would be for you. If you've got maybe an hour or two per week, and you want to move up the food chain for higher returns, you can participate in an equity partnership with a private investor and monitor the portfolio and keep tabs on how things are going. A little bit more time and a partial acquisition is a good idea. Partials are great for starting investors because you're leveraging someone else, another note investor's skill. Since a partial is basically splitting the payment string from a performing loan, this gives both the owner who's selling it to you and you as the buyer of that partial equal, sometimes not equal depending on how the partial is split, but shared risk and shared value within that reperforming loan going forward. So I think this is a great opportunity to learn the business. Buying cash flowing whole loans, you have a little bit more time doing the due diligence and research to buy your own reperforming loans. It's going to take a little bit more time. I would budget for this one at least a couple hours a week. And then once things get going and you can kind of monitor a little bit easier, much less time when you own these reperforming loans and luckily, if they continue to perform, when you buy right, you have pretty strong confidence they will continue to perform. It doesn't take much time. But buying and working on non-performing loans, I would say you need at least 5 to 10 plus hours per week to do this type of business, depending on how large you want to scale. And this is really the focus of this show. And if you understand how to buy and work out non-performing loans, I believe that you'll be in a much better position to invest in any of those different mortgage note related investments across the spectrum, because this at the end of the day is what the professional note investors are doing. They're working out loans that are in default to help borrowers get back on payment plans or gracefully exit their properties that they potentially can't afford anymore. And that's what we do as note investors. We help borrowers come to terms with their finances to be able to afford their mortgage loan or help them move to a property that they can afford. So let's jump back over to note investing in 2022. So the next step here after how to start a business is how to find notes. And how to find notes is probably the crux of the conversation for more experienced note investors. This is what everybody wants to know. How do we get more notes into our portfolios? And as we discussed, I believe that 2022 is going to represent a big year for note investors to find more product available. And this is another hyperlink. This link will get you right over to where to buy mortgage notes / real estate notes for sale. This is another blog post on the FIXnotes site, which includes 20 active note sources and 5 ways to find your own off-market notes for sale. We've got principal sellers, we've got reputable note brokers, and we've got mortgage note exchange platforms. These are all different places you can look to find assets. There's links here, there's more details about each of these. And then if you want to take the next step, you can find your own sources of notes. Now, finding your own sources has many different strategies, and I think we'll definitely cover this in a future episode because it's so important in the note business to understand how to find notes for sale through reverse inquiries to foreclosure attorneys or lenders, to actually market your services as a note buyer to private lenders, to use public records to research assignment of mortgages, to track down distressed debt sellers via tools like Bank Prospector and then LinkedIn to find the right decision makers. And then of course, networking, which is so important. Networking at banker-centric conferences, and then lower down the food chain at mortgage note-centric conferences. Banker-centric conferences are like the next step up the food chain, so you can meet the portfolio managers at the institutional level. But when you're just coming up, the conferences that you should attend are mostly attended by other note investors. So you can start to dip your toe in the water and buy a handful of loans rather than the large bank portfolios that you'll find at these banker-centric conferences like MBA, IMN, and National Mortgage News puts on a conference as well. And then of course, networking is so important that I've started the Mortgage Note Mastermind this past year, and it is the best value in the industry to both find notes for sale, to network with other note investors, to stay in touch with the market via our monthly mastermind members only calls. There's so much within this Mortgage Note Mastermind group, including document templates, our whole database of counties and states. There's a bunch of testimonials over at FIXnotes.com/mastermind. So definitely check that out. And we'll talk a little bit more about that in a bit. So how to find notes. That article will give you a really great start. And the next step, of course, is how to buy them. Once you find a mortgage note, how do you do your due diligence? How do you actually acquire it? So the first thing to understand is pricing. And as we've discussed already on this call, I believe that we're going to see lower pricing in 2022. So in 2021 right now, we're seeing pretty strong pricing for both reperforming and non-performing loans. Now, this graphic is really centered around one-off and small portfolios of reperforming and non-performing loans. You'll see better discounts on the non-performing lines by buying in non-performing loans, buying in bulk. You'll actually see more expensive loans on the reperforming loan side when buying in bulk. It's interesting because in the securitized market, where note investors are selling to very, very large billion-dollar funds, the pricing is actually higher. You're paying more as a percentage of the par value when you're buying and selling at these really, really large levels. They're diversified portfolios and they're traded in just a different stratosphere. So these types of reperforming loans, this is the pricing you'll see on one-off loans bought and sold between private investors. Now, these are generally institutionally originated loans that were in default and then worked out with the borrower to put on a new modification agreement. So we price reperforming loans based on yield. This is an important thing to note because when you have a loan that's cash flowing, you can price based on what's actually happening, how much money is coming in every month. And just like a commercial property where you look at cap rates, in the reperforming mortgage market, you're looking at yields on an annual basis. So for senior liens, we're seeing a little bit lower than junior at 7.5 to 12.5% yields. Some higher, some lower, depending on the specifics around that loan, whether it's owner occupied, whether the borrower's on an automated clearinghouse, an ACH plan, and some other factors on equity and the property quality, of course. Then we've got the junior lien side where we're seeing double digits from 11 to 20% yields. These are your cash on cash return on an annual basis. You'll break even at a 20% yield in 5 years and then have all the upside beyond that. On the non-performing side, we price based on percentage discounts, either percentage discount of fair market value of the home for senior liens or unpaid principal balance for junior liens. Now, when we price based on fair market value, we do always consider the unpaid principal balance because you're not going to pay more than par value. You're not going to pay more than the principal balance that you're actually owed. But fair market value is often lower than the value in senior liens, meaning that these seniors are underwater and we do have to cap our pricing based on the fair market value. On the junior lien side, we price based on unpaid principal balance because often we see junior liens resolving through the borrower more often than seniors, which resolve through the properties. So these prices are always based on unpaid principal balance with a keen eye towards equity. We don't want to pay more than the equity that's in that property on the junior lien side so that we know that we're secured and our invested capital value, your ICTV percentage, is less than 100%. All right, so once you know pricing, and like I said, I believe these prices are going to go down in 2022, which would be a great thing for note investors, we need to understand the mortgage note waterfall evaluation. So the waterfall evaluation is really the crux of your due diligence process as a note investor. And throughout this process, we go through different data sources, different vendors to basically assess the asset that falls to the next step of the waterfall as a quality loan that does require further research, and kick out the loans as soon as possible that don't meet the parameters of our acquisition. The reason we do this is because further down the list, pulling a title report, for example, is about $100. If you're going through the tax research and the bankruptcy research, all of these things cost money and time. And you don't want to review a loan that gets kicked out as unsecured early in the process. So the first thing first is secured versus unsecured. And this is really where note investors have to make a decision of their own investment parameters. Do you want to collect on unsecured debt? I would say most of you probably do not. Unsecured debt, like credit card debt, is a very brute force collection process, I would call it. You obviously need to follow the CFPB requirements for collections, but you don't have the collateral behind the debt that you're collecting on. So it's much more difficult to create a win-win resolution with a borrower. With secured debt, they know they have to pay off the loan to sell the property, to address their equity going forward. So there's a win-win there to get that borrower on a good plan regarding that mortgage note. On the unsecured side, the borrower could file for bankruptcy and get those unsecured debts wiped out. So you're kind of playing a game of chicken with the borrower where you need to get the balance that they're going to pay you lower than the amount that they would, and the stress through the bankruptcy process. And it just becomes a much more contentious situation. Whereas with the secured loan, this is what we focus on in this business, buying loans secured by residential properties, where we can help borrowers come to terms on their mortgage loans in a way that's amicable and supportive to their financial future. So we talked about the secured versus unsecured process back in episode 29. If you want to jump over to episode 29, you can learn all about secured versus unsecured and all of the things you need to understand both to research that data and to determine the results once you get that data back. Then we've got the junior versus senior debate. And I think that smart money prefers seconds. Junior liens are really where it's at for a number of different reasons. And we covered all of those back in episode number 30. So definitely check that out if you want to learn more about the next step of the due diligence waterfall. In episode 31, we talked about collateral valuation methods. We talked on a spectrum of free sources to paid, more accurate sources, and honed in really in the middle here on recently sold comps. Then we talked about bankruptcy in episode 32, both the overview of chapter 7 and chapter 13, and the more tactical decisions and research that you can do through pacer.gov. So go back to that episode to check out bankruptcy. Then in episode 33, we talked about occupancy, the data sources and results. Then we talked about title reports in episode number 34. We talked about senior lien status on credit in episode number 35. We talked about very cool equity formulas in episode number 36, and how you can run some very simple formulas in Excel to extrapolate and put all of your loans in different tranches based on equity. This is in the junior lien side of the business in episode 36. So definitely go check that out. In episode 37, we talked about property tax research, how to do it yourself so that you can understand, especially in first position loans, what type of tax liability is in head of your senior lien position. We went into a lot more detail on that in episode 36 or 37. And then we're back to the non-performing waterfall evaluation. So we went through every phase of this process throughout the course of 2021, and we'll rehash some of that in 2022. We'll condense it in a way that makes more sense, and we'll be happy to answer any comments on any of the YouTube videos for further clarification or upcoming ideas for new episodes. So I'm going to jump over and pivot things here to our pet project, the portfolio analysis that we're running. Not just an analysis, it's a portfolio management process that I'm doing for one of my clients, and we're going to be reviewing the results of that process. I'm going to jump over to the camera here to see if we've got any friends, but unfortunately, we've got no bird friends today. It's a shame, but maybe somebody will show up later in the episode and we can take a break from the mortgage notes to decompress, to de-stress with some friendly birds, but not today, not yet. All right, so let's hop over to the portfolio results, and I'm going to put this up on the screen. This is the original results after 30 days. This was our September 1st acquisition. There was 288 loans, 10.8 million of principal balance. 49 of those loans were senior liens with an $800,000 balance. 249 were junior liens with a $10 million balance. After the first 30 days, we saw 1% of the portfolio receive notices on the senior lien side, and 2% of the portfolio, we had cooperative borrowers calling in. On the junior lien side, after the first 30 days, 8% called in and were cooperative. Our percentage is based on unpaid principal balance, by the way, not based on loan count. So this is weighted with regards to the not the quality of the loan, but the size of the loan. 3% of the borrowers called in were more hostile. 3% we received notices on, and then a small sliver, 1% of the portfolio, right from the get-go, we did achieve resolutions. So after the first 60 days then, we had some more results. We saw a little bit higher percentages of both inbound cooperative on junior and senior lien side. We saw now 4% of the portfolio resolved in the first 60 days. Now, what actually happened in these first 60 days, and I think episode 38 reviewed the portfolio process after you acquire a loan, might have been, I think it was episode 38. We sent a hello RESPA letter, which is a required process by your loan servicer to tell the borrower, hey, we're your new loan servicer, this is where you send payments. And the FDCPA letter, another required letter for the Federal Debt Collection Practices Act, which basically tells the borrower how much is owed, who the servicer is again, to make sure that they didn't miss the RESPA letter and they know exactly what's going on with their debt. So that letter generated a lot of activity. That letter helped us now resolve 4% of the junior lien portfolio by unpaid principal balance. Now, at this point, we had 8% of the borrowers in inbound cooperative statuses. So this definitely stepped up our low-hanging fruit collection, and that's what we call it when the borrowers who are most proactive, most interested in getting a deal done, call in proactively to take the next steps. Now, after 90 days, we've now sent a collection letter through our collection partner as well. And this really showed a lot of positive results. We're looking at the junior lien side more because this is where most of the activity, most of the size of the portfolio was. And as we mentioned before, junior liens, and we're seeing it in the data now, junior liens more often resolve through the borrower. Whereas with the senior liens, 94% of the senior lien portfolio after 90 days still had no contact. And that means that there's going to need to be escalated processes taken, either demand letters in the foreclosure process, which is unlikely for my clients because generally they want to work out with the borrower amicably and then sell the non-performing loan to an investor who's better suited for the foreclosure process in that local geography. So on the junior lien side though, at this point, 30% of the portfolio had some status. 70% of the junior liens were still no contact after those first 90 days. We had 13% of the portfolio now in an inbound cooperative status, only 4% in the hostile status, 4% in notice received, and then 9% now in resolution achieved. So we've almost hit a 10% figure after the first 90 days of collection, with that collection letter being the first more proactive on the lender's side collection step. Now, I will say that the collection letter was very soft. It was not a demand letter by any means. This collection letter was basically just telling the borrower that if they were able to get a deal done before the end of the year, they would have a much better opportunity with their negotiations to get the best deal on their loan. So that's the portfolio results after the first 90 days. And just to look at this in a little bit more granular format, and I'll make this bigger here. This was the hello letter and the FDCPA letter after 30 days. Then after 60 days, one loan did fall off as an unsecured loan. And then after 90 days. So just to dig into these results a little bit more, we've got 4 and 4 for inbound cooperative and resolution achieved on the first lien side, representing 27,000 and 19,000 respectively of unpaid principal balance, around 8% account and 3.5 and 2.5% of the unpaid principal balance. And a huge percentage of no contact, 94% of the unpaid principal balance, 83% of the loan count had not made any contact after the 3 steps, the hello letter, the FDCPA letter, and the collection letter in 90 days time. On the second lien side, we've got a little bit more interesting data here. Now we're looking at 12.2 and 12.9% of the portfolio in the inbound cooperative status by count and unpaid principal balance respectively. And then following down the line here, up to almost 10% of the count and 9.2% of the unpaid principal balance achieving resolution. That's 23 loans of 238 loans after 90 days of the process are what we'd call the low-hanging fruit here. Borrowers who are looking for a place to pay, they're ready to start paying again. They just needed to get that contact with their lender and their loan servicer so that they could get back on track. And then of course, we got that one loan for a $99,000 balance that was found out to be unsecured. And unfortunately, that's part of the business. If your due diligence lacks in any capacity, sometimes some loans fall out as unsecured. In a almost 300 loan portfolio, this is more expected. If you're buying a smaller portfolio, you can go with a fine-tooth comb through your portfolio and really identify those unsecured loans before you purchase and price them accordingly. In this case, some loans did fall through the cracks here, but as representing only 0.9% of the unpaid principal balance or 0.3% of the entire portfolio, not too bad of a result, and we're pretty sure that's all the unsecured that slipped through the cracks here. And just as a side note here, I do want to mention that as a note investor with a quality counterparty, an unsecured loan that became unsecured prior to your cutoff date on your loan purchase sale agreement is a remedy to the contract. You can actually call up your lender, call up the lender you purchased the loans from, call up the seller, and request that that loan is repurchased because it was misrepresented as a secured loan at acquisition. Now, not every contract has representations and warranties as part of the agreement, but that's something that can be negotiated when you acquire loans, and all of the portfolios that I sell through my clients include that representation and warranty unless otherwise negotiated, that secured loans are represented throughout the portfolio. If a loan turns out to be unsecured prior to the cutoff date, Now, just to further clarify, the cutoff date is the event date of the portfolio. It typically occurs around the date of closing. That's the date when the loans become the buyer's loans and the buyer's problem. Anything that happened before the cutoff date was the seller's problem. Not to be confused here with the final remedy date of the contract. There's another date which specifies how long the buyer has to request repurchases, and that typically is 3, 6, maybe even a full year after acquisition, but rarely that long. I think 6 months is normally a pretty standard place to set that date. That's not the cutoff date. That's the end of the repurchase and warranties date. The cutoff date is when the loans become yours as the buyer. All right, so let's jump over to the next slide here and see. We're going to drill into these two categories. First liens for inbound cooperative and resolution achieved, and inbound cooperative and resolution achieved for second liens, and see this now in a pie chart. So now we're looking at just the loans that have had positive traction, achieved and pending resolutions, once again by unpaid principal balance, so it's weighted against the size of these loans in the portfolio. Now in the first 60 days, we saw 54% of the senior lien portfolio as potential mods, 64% of the portfolio as potential mods and junior liens, and then full payoffs, discount payoffs, and modifications following. Now we didn't see any discounted payoffs on the junior lien side in that first 60 days, but if we look over to the 90-day category, we can see now a different breakdown. We're seeing now 59% of the senior lien. Now, keep in mind, this is not the entire portfolio. This is just the loans that have had positive traction towards a payoff or some other type of resolution like a modification agreement. And then on the junior lien side, 45% are now potential mods, 20% are successful full payoffs, 11% are discounted payoffs on the junior lien side, and 23% are modification agreements. So this is the traction so far after the first 90 days. And the next step here is probably going to be taking place very soon, one final letter, and then putting these loans out for sale that are still non-performing. Now, reperforming loans from this portfolio may come up for sale in the near future, but it won't be for at least 6 months. That's an important thing to understand as both a buyer and a seller of reperforming loans. There's a seasoning period where note investors want to either see as a buyer that borrower has a successful track record, or as a seller that they can get the highest price for a loan because the borrower has already proven themselves. So seasoning just means consistent payments being received, and that can take place over 6 months to a year. Now let's jump over to our next section, which is tech tips. And let me bring up some music here to introduce the hardware and the software that's required in this business to operate from anywhere in the world. So hardware is a capable PC or Mac, a decent smartphone, fast Wi-Fi or cellular connection, and the software and web services that we use span across Podio, Pacer, Citrix, Podio Workflow Automation, Right Signature, Gmail, Zapier, CoreLogic, DataTree, Zillow, ProTitle USA, Google Sheets, Excel, of course, TransUnion, and TLO. So these are all the different services that we use to make our business work, with Podio being the backbone. Podio and what was previously called Globoflow are really what we use to automate our APIs, to automate our processes, to get different connections between these different web services dialed in a way that makes it automated and efficient for you as a note investor. Now, I do want to encourage you once again to join the mastermind group, because the mastermind group portal, the back end of our group where all the content lives, is built on Podio. So you can join the mastermind group and get a feel for Podio so that you can decide whether or not you want to use it for your business as your CRM and information management platform. I use Podio personally. I think it's the best way to manage both my contacts, my notes, all the deals we've got going. There's a great iPhone app, and what's really cool about Podio, even if you don't join the mastermind, you can create a free Podio account, and then you can operate without the power of Citrix Podio Workflow Automation. You can operate just within the tables and databases, so you can get a feel for it, start to build out your system, and then when you're ready, unlock the rest of these features with Podio Workflow Automation. So Pacers for bankruptcy records, we've already mentioned that once on the call when we talked about bankruptcy. Right Signature we use to have purchase sale agreements executed by our buyers and sellers. We don't use Right Signature for borrowers because we like to have wet ink so that those documents can be recorded in the county record when necessary. Then we've got Gmail, where so much of our day lives in this, and I think maybe I speak for all of us, a lot of emails in the internet businesses of the world. If you can move these emails over to automated services, that can make things much easier for you, but it's a necessary evil going through the inbox. Then we've got Zapier, which is an easier way to create automation similar to Citrix Podio workflow automation, but can be done without code. And I'd highly recommend using tools like Zapier to create your minimum viable product, your minimum viable automation, we'll call it, and then use more advanced, more sophisticated coding with the help, if you don't know coding yourself, of a professional to turn them into more robust interactions between these apps. Then we've got CoreLogic. We went through all the CoreLogic lean report output in a previous episode. I think it was episode 20 or before. You can find that on the channel. This is what we use for bulk research. And then we've got DataTree for one-off research. Two excellent tools to work with as a note investor to gather a lot of data on credit, value, public record, whole bunch of information here that's very useful. Now, credit is not through DataTree, but you can get credit through CoreLogic, just to clarify that. We've got Zillow, where we really like to use, they're very easy to use tools for MLS, previously sold comps, and for other, we can sometimes but sometimes consider the Zestimates and even the rent Zestimates in Zillow. Then we got ProTitle USA for our O&E, ownership and encumbrance reports or title reports. Google Sheets and Excel. Both can be used in a similar way, but I would say Excel is way more important. And just to add another layer of decisioning for you with regards to your information management, you can use Excel instead of Podio, especially in the beginning, to create a master database of your loans, master inventory of assets. And Google Sheets can be more useful if you are collaborating with a team, but Excel has a little bit more power and functionality if you're going to just keep it on your own device. I would highly recommend, at the very least, having a master inventory of your loans in Excel. And then eventually you might want to migrate that into a platform like Podio. And then finally, TransUnion was recently, I'm mixing it up. TransUnion acquired TLOXP. TransUnions are credit bureau of choice generally, and TLOXP is a skip tracing vendor. So all very important services that you can tie into your note business. All right, so that's it for the tech tips, and we're going to hop over to assets for sale is our next category here. And now I will once again pitch the mastermind group, because the mastermind members are going to have first and total access to the upcoming portfolio of loans for sale, which now is slated for around the end of January, beginning of February, Q1 2022. Non-performing first and second liens from the portfolio that we've been reviewing in the last 3 or 4 episodes on this show. So you can take the next steps on these loans and potentially collect some more low-hanging fruit. There may be many of these borrowers who haven't yet responded to the RESPA letters that may respond to your loan servicer's RESPA letter, or go through the next step with a demand letter to really get the borrower understanding that this is a serious matter to bring their secured mortgage loan back into a current status. And then, of course, we've got the aggregated trade desk on the mastermind, where we have opportunities available now for sale. Just helped one of the mastermind clients unload 2 of their non-performing loans, trailing assets at the end of a portfolio that they were looking to close out, and they were sold to another mastermind member. So a lot of deals actively happening on the aggregated trade desk, where we've put over $17.5 billion of unpaid principal balance in 2021 alone. So a lot of deals happening over there on the aggregated trade desk for mastermind members only. All right, all that being said, now it's time to jump into case studies. And case studies are so important. It's where the rubber meets the road, and we can really apply what we've learned on this show to actual events taking place in the business. So this first case study is a non-performing second lien secured by a single family residential property that was resolved through the modification process and then sold for $23,792. So this reperforming loan had a fair market value of $262,570, a senior lien balance of $108,513, leaving equity of $154,057. You can run those numbers by deducting the senior lien balance from the fair market value to reach the equity that's securing the unpaid principal balance. So this is an interesting point to make. Equity in this sense is from the investor's perspective. From the borrower's perspective, you'd have to further deduct this equity, $154,057. You deduct the junior lien balance of $26,000 to see where the borrower stands with regard to equity. So it's important to look at it this way as an investor, because you're owed $26,000, but there's $154,000 above your lien. And for the investor or for the borrower, they owe both the senior and the junior. So it's a slightly different calculation. In this case, it doesn't matter much because there's plenty of equity for both the senior and the junior. But on some deals, you'll see the borrower being underwater, but the investor having some equity. Perhaps it's around 100% loan to value, which would mean the borrower is right on the money. Their property value equals their senior and their junior lien combined. But for that junior lien investor, they've got equity. Their invested capital to value is less than 100%. So let's jump into it with the non-performing loan costs of $8,800, which are 30% of the original unpaid principal balance of $29,000. So by the time this loan was eventually sold, the balance was $26,000. But when it was acquired by my client, who we did the modification with for this borrower, the balance was $29,000. So the three questions we always ask when we first get in touch with a borrower are: what happened, where are you now, and what do you want to do? And these questions are so important because they help frame the conversation in a way that supports the borrower's finances and doesn't go against the grain to try to acquire a property where the borrower can afford the property and wants to pay the property. You could, in this case, if you were not responding to the borrower's needs, you could try to force a foreclosure process and end up in a position where you're spending all these legal fees and the borrower is spending legal fees and everybody's just paying the attorneys rather than just getting a deal done, because this borrower clearly has equity in the deal. They want to get something done. And the first question here was answered with the borrower was actually paying the bank before the loan was sold. So this is a unique situation. This was a loan that was charged off, but the borrower wanted to keep paying it. So they got on a plan with the bank that was not documented. They told the bank, after being in default and getting their loan charged off, that they wanted to pay the loan. But unfortunately, when a loan is charged off by an institutional lender, a big bank, I have never heard of a reversal of that charge-off process. Once a loan is charged off, they can collect the payments through not the regular department that would generally set up a modification agreement, but through an ad hoc system that doesn't really document the payment plan. And we've seen this time and time again where borrowers were trying to make payments, but there was never any documentation, and then the loan was eventually sold as a non-performing loan. So in this case, the borrower was paying around $500 per month, and they wanted to keep paying $500 per month. They wanted to pay off the loan earlier, but they wanted to just have a modification in place so that they'd have clarity around the repayment terms and the current loan status. That's the problem with the charged off loan. There's really a lot of ambiguity around the status of that loan. If a refinance lender wanted to help them refinance this junior lien, the bank who was collecting these payments would tell the lender that the loan was charged off. There wouldn't really be an effective mechanism to get this loan refinanced without a modification and a payment history and really an effective resolution process, which is what an entrepreneurial note investor can do to help the borrower, to help the bank, to help all counterparties in this deal. So in this case, the borrower is working on getting their finances back in order. And what do they want to do? Start a no down payment modification agreement at $500.40 per month, which worked out to an 8.75% interest rate. And that would help bring the loan current. They couldn't afford the down payment, but because we were able to get this process started really quickly after acquisition, we were able to give them that opportunity to start a mod without paying a down payment. So throughout this process, a 13-month process and $555 of expenses, which included the due diligence and acquisition costs, onboarding with the loan servicer, those monthly servicing fees, and the collection process, we eventually were able to sell the loan for $23,792. So this took about 13 months because we were able to get the loan resolved very quickly within the first month and a half, and then wait for those 12 about months of seasoning before we sold the loan for the best price at the time. So let's talk about a couple takeaways on this deal. The first takeaway here is that the low-hanging fruit after a bank portfolio acquisition often includes these borrowers that have the ability and the means to start paying, but they just need the documentation to turn their charged-off loan into a current account. that charged off status is really detrimental to a borrower's credit, to a borrower's ability to get underwritten for new loans. And by putting a modification agreement in place and then working with the subsequent lenders who maybe are working on a refinance, we're able to put that borrower in a much better financial situation. So another takeaway here is if you do need to raise capital by selling reperforming loans, keep notes on all of your borrowers so that you can understand exactly who those borrowers are and understand two things. One, how much to sell the loan for, and if you want to retain a loan, which loan you might want to keep because the borrower is consistent, they're on an ACH agreement, for example, they have plenty of equity. So that's why we like using Podio or even in Excel, keeping a master inventory, because you can keep those notes when a loan is originally modified so that when you look at the portfolio in the future, you can decide, well, we need to raise some capital, so let's sell this loan, and we can explain to the new loan investor, the buyer of that loan, why this borrower is such a great borrower, and hopefully add a little bit more of a premium to the loan sale. And also understanding potential early payoffs and consistent payers is another factor here. This borrower did want to pay off the loan early, but unfortunately by the time we needed to raise capital for this client, they hadn't yet refinanced the loan. But it would have been ideal if we were able to keep this loan to help the borrower in a refinance to get a full payoff. So instead of $23,000, we'd collect that full $26,000. So in this case, the risk to reward wasn't huge. It was worth it to sell the loan, and the investor who purchased it and the non-performing loan fix and flip, the client here, both earned an excellent return. So for the investor who bought this loan for $8,800 and then sold it for $23,792 in 13 months, they earned a 157% internal rate of return. Now, when we were talking about reperforming loans earlier, we were talking about cash on cash returns, but internal rate of return is a much more exacting investment calculation that you can do. And I like to use XIRR in Excel to calculate my internal rate of return, but you can also do kind of a back of the envelope type of calculation as well by calculating your ROI and then putting that in terms of time value of money based by using the denominator of the denominator is your months until acquisition, phrased annually. So 13 months would be 13 over 12. And that would be the denominator with the ROI on top. Now, we've went over this in the blog. We actually go over case studies on a regular basis on FIXnotes.com/blog. And one of those case studies had some very specific instructions on how to do this back of the envelope ROI and IRR calculations. So definitely check that out if you'd like to learn more about that specific calculation. On the other side, the cash on cash return for the reperforming loan investor was 24%. So they were going to break even on this loan within almost 4 years and start earning a profit on top of their acquisition price in the 5th year. So really great return for a reperforming loan investor, higher than the returns that we're seeing in today's reperforming loan sales market. All right, so that's it for the first case study, non-performing second secured by a single family residential property. This next one is a non-performing first secured by vacant land. This one was resolved through a discounted payoff. So it's really nice to see a totally different type of deal here. Different in every way, different in the resolution method and different in the collateral and the lien position. And this one was resolved with an exit of a discounted payoff for $10,000. So fair market value on this one was $33,000. We'll actually find it was less than that. We had an HOA and a tax balance combining of $28,000, which only left $5,000 of equity, protecting our $31,000 balance. So pretty rough position here for the borrower. This loan was purchased for $3,150, which is about 10% of the unpaid principal balance and 62% of the equity, so we thought. Now, the equity did not turn out to be that high. And what happened in this case? Where are you now and what do you want to do? The three most important questions. Well, the borrower fell behind on their taxes, their homeowners association, and their mortgage, and they had limited income. So this was a really, really tricky spot. Where are they now? Well, they responded to our options letter. We had a collection firm send out an options letter, which offered an $11,000 discounted payoff with a supportive letter. So this was sort of an extra carrot here, an extra incentive to help the borrower. We were going to send a supportive letter. They were potentially going to borrow some money from their family to pay off, but they needed to keep the lot. They really wanted to keep this lot and fix their credit. But The fair market value was less than expected. So that fair market value, not $33,000, the equity, not $5,000. So they responded to this option letter and they said, we can pay $7,500. And after some back and forth, they showed us recently sold comps in the marketplace for other lots. It was worth a lot less than we thought, but we did eventually agree to $10,000, which was about a third of the amount owed, and offered the borrower some savings. But unfortunately, in this case, since they didn't have much equity, this was more of, I wouldn't call it an emotional decision, but this wasn't a decision that was grounded strictly in the numbers. They wanted to keep this lot because it was something they wanted to keep in their family. So it took 12 months for this deal, $850 of expenses. We often see higher expenses on first position loans versus second position loans, both in the due diligence and in the management process, which we talked about in our due diligence waterfall on the first versus second lien slide. So you can go back to that episode and learn more there. And eventually we resolved it with that $10,000 discounted settlement. So a couple of takeaways here. First of all, non-monetary incentives can be effective, very effective. In this case, that supportive letter to the credit bureau was really important to the borrower. They were happy for that help to work out their credit, because once a loan is charged off on their on the credit report, it can take up to 7 years for that charge off to no longer be reporting as a trade line. So by creating this letter and sending it to the credit bureaus, or having the borrower send it, it can support the borrower's credit score going further to help get that trade line that's marked as charged off of the list because it was now paid off. Underwater borrowers, here's another one. Underwater borrowers are not automatic strategic defaulters. This deal, after reviewing the real numbers with a fair market value of $18,000 and putting us at a negative $10,000 equity, would not look like on paper like it would be a payoff of any kind. A strategic default is essentially when a borrower says, well, take the property, I don't want anything to do with it. It's not a good decision for a borrower because they can then be hit after the fact with a suit on note and have to owe the amount that's still owed on the loan, the deficiency judgment. But in this case, they wanted to get it paid off, which was a good decision because technically that $30,000 balance, they would eventually be pursued for that entire balance, potentially as a deficiency amount, unless they filed for bankruptcy, which just becomes a whole nother set of decisions and situations for that borrower to navigate. So in this case, they wanted to pay it off. Even though the numbers didn't make sense, they were able to pay it off to help their credit score, to keep the property, and to save over $20,000 on the balance of the loan. So in this case, the non-performing loan payoff return was 217% internal rate of return. We went from a $3,000 acquisition to a $10,000 exit in 12 months on this deal, which offered us over 200% internal rate of return. So that's something interesting to see in non-performing loan portfolios. You often see the highest returns on the loans that are in less desirable situations when acquired. And that's why I highly recommend any note investor to diversify into a wide variety of different types of loans. If you're only buying second position loans behind current senior liens with plenty of equity, you're going to be paying top dollar. And although you can definitely mitigate your risks and have some expectations of a strong return, but not as strong, these types of deals are the wild cards where you can get really outsized returns if you include just a couple of these in a portfolio. And you can subsidize a deal like this with a deal that's got plenty of equity, like this last reperforming loan we talked about. So that's it for the case studies for today's episode. Let's jump over to giveaways and mention our 15-minute consultation. So if you'd like a 15-minute consultation with me, I'd really appreciate it if you subscribe to the channel, like this video, and leave a comment with a question or any types of, any comment would be greatly appreciated. A critique would be awesome. I'm always looking to improve the show. After you do that, go over to robbymax.youcanbook.me and get on my calendar. I would be so happy to get on a call with you to talk about any number of things, whether it's specifically mortgage notes, real estate in general, or business and my philosophy towards my YouTube channel, for example, or anything that maybe would be most supportive to you and your career. So the upcoming schedule then, we're gonna get on our next mastermind call. Now this is for members only, and that's coming January 5th. That's the first call of 2022. Oh, that's incorrect. January 5th, 2022. And then we've got our next Be the Bank episode, the final Wednesday. That's coming up on January 26th, 2022. And one more time, let's pitch that mastermind group. The mastermind group is our website, of course, a resource to the industry, the mastermind for savvy entrepreneurs, and consulting with me for your success. So that mastermind group right now is $110 per month. With every 10 new members that join, the price increases by $10 per month. Now our goal is to get to over 200 members in 2022, and that will take the monthly price over $200 per month. And eventually it's going to be upwards of $900 per month, because we're eventually going to get to 1,000 members, and that will be the absolute cap. If you join the mastermind group, consulting calls are 50% off. And of course you can get on that free consulting call with me. So much value to unlock in the mastermind group over at fixnotes.com/MNM, or just fixnotes.com/mastermind. If you're already a member, go over to podio.com/fixnotes/mastermind, and you can access the entire portal. And that is it for today. Once again, thank you everyone for joining. I'm so excited every single month to prepare and present this show to you. I would be more than happy with comments and questions, anything I can do to help you with your business. So until next time, have a wonderful new year, and I'll see you then. Once again, this has been FIXnotes Be the Bank, industry overview, tech tips, vendor reviews, assets for sale, case studies, giveaways, and so much more on Be the Bank last Wednesdays of the month. Thanks everybody. There's no birds to see, so we're just gonna call it there, and I'll see you the end of January for our next episode, or January 5th if you want to join the mastermind and get on our private calls. All right, everyone. Have a good one. Yeah, I'm still here. All right, see ya.